Hi, everyone. This is Jason Burak of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's founder and CEO at Curzio Research. It's one of the top small cap investing newsletters on the planet. He's the host of one of the top investing podcasts, Wall Street Unplugged, and he's worked on Wall Street for well-known hedge fund managers and stock pickers like Jim Cramer, and also in the past for Stansberry Research. Frank Curzio, thank you for joining me again.
Thanks for having me on.
Now, Frank, maybe before we talk about your investing methodology for small caps and how you have a long track record of picking out winning small cap companies despite the changing market conditions, let me get your opinion on something that your father did that was really, really well known. So for our listeners who are not familiar with your podcast and with your work, your dad, who is a famous value investor, he called the 1987 stock market crash. So if he were alive today, what do you think he would say about some of the stuff that the central banks have done during the 2008 financial crisis and since the 2008 financial crisis? Would he be issuing warnings right now? And also, how did he call the 1987 crash, since I'm sure you talked to him about this? What type of insights?
Yeah, man, like that was awesome. He was one of the only people that got credited for. I don't know anyone who got credited for calling the crash in writing in 1987. Like it's like the current crash, right? 2008, 2009. Everybody called it. I don't know if you know that, but everybody called it, right? At least they think they did. But back then, it wasn't like the CNBC today, where you have thousands of people, you have blogs, real-time information. There was only like a good 8, 9, 10 people that people listened to back then, because CNBC was a lot smaller in the 80s. And, the Navaliers, Louis Navaliers, you had Gabelli back then, Lynn Gazzarelli, and Jim Cramer and stuff like that. And everybody was extremely bullish. And he was writing a financial newsletter at the time, entitled it, and I have the newsletter, which is incredible. So to this day and it's October 1st, and the title of it is Crash. And he says, this crash is going to be worse than the prior three combined. And, people thought he was absolutely out of his mind, but what he saw was rising debt levels. Emerging market debt was incredible. He saw a Fed that really was, out of control as well, not really in tune with everything going on. Valuations were really inflated. But the big difference back then is interest rates were incredibly high. And we had lots of debt, where interest rates are very low now, and we still have debt, and that's why we're seeing interest rates rise now, and we're seeing inflation everywhere, even in wages, believe it or not, where wages have grown last quarter, and I bet you this is a stat a lot of people don't know, have grown 3.2%. That's the highest amount of wage growth we've seen since 2007, quarter over quarter. That's a sign, finally, right? Because you and I know, and everybody listening to this knows, that we see inflation. The Fed's going to say, well, we're not really seeing inflation because they exclude food and energy out of the consumer price index. But we're seeing it everywhere. I mean, it's amazing. Food, you go to fast food places, tuition, healthcare, you look at everything, every single thing, rent, home prices, electricity bills, and now you're finally seeing that last component with wages, because unemployment is basically at zero. If you want a job in this market, you can get it. But if you want to hire quality people, you have to pay for them. Now, this isn't me guessing. I'm just saying that I listen to tons of conference calls every earnings season, and I have to say, if I listen to over 150 to 200, some I listen to, most of them I get updates for through my systems, everybody's worried about high labor costs. They have to pay more money to hire these employees, especially in the trucking industry you're looking at, across the food industry. It's even the infrastructure. They're thinking about passing an infrastructure bill, which, our sides probably won't get together to do, even though they both agreed we should have $1 trillion infrastructure bill, but both of them just can't agree on it. But who's going to build this stuff? You got to hire the people, and a lot of people are hired now. So the big difference with that market and today, yes, you have inflated debt levels, but interest rates are a lot lower, and that's a big difference. Even if you look at the credit crisis, right? You're looking at people don't realize that I've said this, and people think I'm crazy, and I know nobody wants to hear this, no one wants to believe it, but I'm a data-driven guy. I'm not a perma-bull or perma-bear, but the chances of another financial crisis, like the end of Western civilization, is probably not going to happen in our lifetimes. I'm not saying the market can't come down 20, 30% like a normal correction, a normal crash, but I'm talking about what happened in 2008, 2009. People have to realize the banks were leveraged 34 to 1. This is what happened in 87 as well. You're seeing a lot of leverage in the system where home prices only needed to decline by 4 or 5% to wipe out your entire equity. These banks are being monitored now, and by the Fed, they have stress tests all the time. Again, they have a lot of derivatives. We have a lot of debt out there. We understand it. We all know this. We didn't know about the credit crisis. We didn't know about CDOs. We didn't know about synthetic CDOs back then. But these banks are only leveraged 10 to 1. It's almost impossible to make a run on a bank. I mean, again, if I have $100 million in cash in the bank, no matter what you do to me, I still have $100 million. If I have a publicly traded company, it falls under their value. I have $100 million. But if you have debt that you have to pay, you could continue to pound that, and you could put someone out of business. And that's what happened during the credit crisis. With that said, one of the biggest risks to the market right now is higher interest rates. I think the Fed's making a big mistake raising interest rates when we're finally seeing inflation, and we're seeing a lot of inflation. And inflation comes very, very quickly. It's like pushing a train downhill, and once it gets going, boom, it's almost like too late to know. And that's one of the things that worries me. But what I do like is, if you look at everyone who cites risk, we know $21 trillion in debt. We know that emerging market debt is priced in dollar-denominated dollars. We see it down the road. As long as we're seeing a lot of this stuff, it's a lot different from 87, which nobody saw it. And it's a lot different from 2008, 2009, where you're looking at CDSs and CDOs. Nobody knew that people were buying houses, and they had 10 houses with no equity in any of them that they could walk away. So it's a much different scenario, but debt is definitely a major concern.
I think European banks are by far a bigger risk than American ones. I don't think the European banks were as recapitalized as the American ones post-2008.
I agree with you, but if you want to look at data, right, and you want to see what's going on, and you have consumer default swaps, right? So it's basically insurance. You're betting against something to fail. And the European banks right now, if you look, we saw Italy come out, right, and say, Italy might not be part of the EU anymore, right? So we saw that happen. Where, and even going into like the last few months, where we're seeing, Brazil having problems, right? So we're seeing, just a lot of countries out there really having trouble. Turkey now, right? And you have Argentina, because a lot of debt is priced in dollar-denominated dollars. So when we look at that, one of the things to notice, if you look at the spreads of CDSs of the 30 largest European banks, it's actually lower now than it was during 2011, 2012 credit crisis, which means the smart money, the money that bets against this stuff, you would see that rise dramatically if there really was a major concern, and it's still below their crisis levels in 2011, 2012. Regardless, I know that people are going to listen to this and say, this guy's out of his mind, he doesn't care, or whatever. I'm just telling you, when we look at the data, try not to be programmed to just listen to everything on TV that the world's going to end, because we've been hearing that market's going to crash for 6-7 years from people, and so many people have been out of this market. And what I'm trying to explain here is that we could see a 10-20% pullback in stocks, which is normal, and we're due. But I wouldn't have those fears where the whole entire industry is going to end, rise industry, ATM is going to work. Usually when you have those kind of crazy forecasts, somebody's trying to sell you something.
Do you think then it could be, you mentioned the spreads there and that smart money would have been betting on the CDSs for the European banks. Do you think then that could have been the European Central Bank intervening then and buying those things up and making sure that the private sector doesn't have access to do a run on those European banks? Because, I mean, look at the intervention that we've had from all the central banks. I mean, it seems to me, Frank, that the central banks, the 5 or 6 largest ones, the Swiss Central Bank is a technology hedge fund now with billions of dollars in tech stocks. It seems they want the asset prices going up. So, calling a crash, you didn't understand the policy the central banks want. The central banks want the stocks, the bonds, the real estate prices. They don't want them to fall.
Mm-hmm. No, I don't agree with that. I don't see that happening, or they're intervening with credit default swaps. I mean, that number would go up, regardless. I mean, again, but what you're doing is I think what a lot of people look at this is, I'm not saying this that I agree with it. I hate it. I hate the fact that we got bailed out. I would have loved to see some of these things go on there, but in reality, if it was, you'd probably still have a 30% unemployment rate, which a lot of people wouldn't talk about. I hate it, and I know you hate it, and a lot of people hate it, but you have to realize, as an investor, you got to take your personal feelings aside, because what's going to happen if our market crashes again? And I'll ask you this, Jason, to all your listeners. What do you think is going to happen if the market crashes again, and say there's a big run and we have a similar crisis? What do you think the Fed's going to do? What do you think they're going to do?
I think they'll change the rules and print more. Maybe Bernie Sanders wins the election.
But that's what they're going to do, right? Well, I hate it, and you know why they're going to do that? Because they made a fortune the last time they did this. They made a fortune on Fannie and Freddie. I mean, it's so much of a fortune. They thought they were going to be zombie banks, and in 3-4 years, they're making billions, tens of billions of dollars, and that's why you're seeing all the hedge funds saying, they should be privatized, and they don't even know what to do with them. They're making so much money. AIG, they bailed out, they made a fortune. All the banks they bailed out, they made a fortune. All the home price, everything that they took under, everything went inflated in value, which is the worst thing that could have happened, because if the market comes down again, what do you think they're going to do? Again, I'm not saying this to your audience where I agree with it. I hate it. I'm talking to you as an investor.
Yeah.
So we have to realize that, because I didn't realize that to 2011 when a great guy that I follow, a lot of hedge fund guys, but David Tepper got on CNBC and he said, with the Fed doing everything they can, they're giving checks to people to buy houses and cars. They're actually giving away money, incentives, right? And everything. He goes, it's going to go higher? And I remember listening to it. He goes, everything's going to go higher. They're basically put a backstop on every single asset. So companies like Navy, its student loan provider, take all the loans, and all the big banks are going to make it bigger. We're backstopping everything, so there's basically no risk. And we're going to inflate the markets, everything we can. We're going to bring interest rates to zero. And he was exactly right. And a lot of people, I think, and I've made these mistakes in the past. I've been doing this 25 years. My personal feelings get involved, and I'm like, this is crazy. And you almost want it to happen, but when you take a step back, it's like my dad actually passed away from lung cancer, and I was always against all the tobacco companies. But when I look at that and I say, are they good investments? They're fantastic investments, right? So, these are companies that got sued and what. But for me, my personal things were always involved with my dad. So, when I'm looking from an investment, you got to look at things where you could have your personal agenda. That's fine. If you're looking from an investment perspective, it's fine. And right now, if you're thinking about debt, you're thinking about debt for the last 6 years, right? Obviously, it keeps going higher and higher. And if that's kept you out of the market, you're losing a lot of money. Could this blow up one day? Absolutely. But right now, we still have relatively low rates. We have a market that, based on current earnings, is trading at 16.5 times forward earnings, which I'm worried that, it's growing 25% year over year, and that's not going to happen next quarter and the quarter after. But at the current rate at 16.5 times, it's the same valuation we've been trading at pretty much the last 5 years. And that might be hard for people to believe because the market's up, but remember, earnings are tremendous as well. So at 6.5 times, the 5-year average is right there. So if you look at our, earnings could come down next couple of quarters, which, I think is going to really happen. But if you're looking at a market that's super expensive and we were like 44 times earnings during the tech bubble, and we're at 16. So maybe earnings don't meet estimates next couple of quarters. That means we're going to be a little bit inflated on the valuation side. Maybe they come down, but you're still able to find lots of ideas. You're still able to find really good things, and you just have to be careful in this market because, some of these things are valued very, very high, especially in technology, but there's still a lot of good ideas out there that aren't trading at 52-week highs, believe it or not, even though the markets are at 52-week highs.
Excuse me, what did you just say? What's at 52-week highs?
No, with the markets at 52-week highs, believe it or not a lot of stocks are at 52-week highs. So we're looking at stocks. For me, there's a lot of stocks. If you look at the S&P 500, if I had to guess, and I did this probably, let me see, this is a couple weeks ago. I think it was 300. You look at 300 stocks from 250 because the S&P is up, like 2-3%. But, I mean, there was like 300 of the 500 were actually down on the year. This was a couple weeks ago. Yet we're trading, and again, we're only up a little bit from the S&P 500, which came into the year at a record high. So we're up a little bit here, but you would think like every stock looking at it because we're in the biggest bull market ever. It just right with the headlines that we're seeing. And these stocks are doing great. People look at Amazon, they look at Apple. But a lot of that is weighed towards the bigger companies that are hitting 52-week highs. But there's a lot of companies underneath that aren't doing as well, and we're able to pick a lot of those off in different areas because they're 20-30% off of their highs, believe it or not, when you look at individual stocks.
That's very interesting. Yeah, the FANG stocks have been responsible for a lot of the market rally for most of 2018. I forget the exact number, but the FANG stocks have been responsible for a lot of it. I agree with you. I think, if there is a stock market crash, there's really nothing to stop the central banks from, printing more money again and moving the stock market back up. In fact, there would be a lot of people, and I'm not in favor of this, but there would be a lot of people, even my mom and dad who have like 401ks and IRAs, they would be in favor of it. So they don't agree with my views of the world, but a lot of the regular people on Main Street, as long as their retirement account that they check, their stock value is up, they really don't care.
It's not even a question of caring. I think we all want accountability, right? I mean, you're using banks that did stuff behind our back that we didn't know about to inflate their assets. And fine, if you're going to do that, you're going to do that. But the risk is when you get caught, you should go to jail. And when you don't go to jail and you're using taxpayer money to bail them out, I don't care if you're on Wall Street, maybe whatever. I mean, it's a terrible scenario. I mean, how many people went to jail for that? I think it was like 2 people maybe that went to jail. I mean, they're still throwing fines at these banks. Even now you're seeing banks get fined for things that they did in the credit crisis. Even the past couple of years, so I have lines going by. I don't know, Wells Fargo's or whatever, Wells Fargo. But, none of us are in favor of that. But, again, you just, in this market and things like this, you have to put your personal feelings aside because there's so many people that I see that are so ticked off about the Fed, about our government and what they're doing. But as an investor even, investment opportunities and stuff, you have to look at it a different way and put your personal feelings aside and see what works and what doesn't work. And if you looked at it, you'd realize the last 4 or 5 years is one of the, just an amazing market, bullish conditions. We're seeing it on retail now, where retailers are coming out and saying, I've never seen a strong market than this. If you remember in October, I thought every retailer was dead. That's what everybody told us. The big box retailers are dead. They're all going out of business. Malls are dead. Malls are dead. Now they're all like, 52-week highs. It's up tremendously.
Do you think
you got to be careful of the media out there?
Do you think that's because of the Trump tax cuts, or do you think there's other reasons for that?
I think, if you look at the earnings growth of 24-25% this quarter, I would say about 40% of that, is tax cuts, regardless if you believe it or not. Again, it doesn't matter if you like Trump or not. We have tax cuts, and they're put in place, and businesses are generating more money. People are ticked off because they're saying, well, it's not going to wages. But last quarter, we saw a massive increase in wages. And I think, a lot of these companies, the biggest companies in the world, are saying we're seeing high labor costs. So they're going to have to pay their employees even more. But when you look at the sales, right, which is a good indicator, sales are growing year over year, 10% this quarter. After this, they just finished reporting. They just 98% of the S&P 500 companies reported earnings now. Those are sales of 10%, right? So, you can't fake that. So you're seeing growth. You're seeing people spend money. You're seeing the houses go up in value tremendously. I think it's like $6 trillion now that they have in home equity in their houses, and a lot of them aren't allowed to take it out because of the current laws anymore. Well, you could have took the whole entire thing out during 2005 and 6 and bought another bunch of houses and then walked away. A lot of these banks are saying, no, you can't buy a second house. Even I had trouble buying a second house. It didn't matter if you had enough cash to cover the house 5 times over. They didn't want to give you a mortgage. It's, so it's a lot more tighter than it's been. Again, I don't see a credit crisis on the horizon, but for me, I think there's still a lot of opportunities, and I think the bull market is definitely going to continue for at least another 6 months to a year. But we do have to be cautious and monitor earnings, because when earnings stop growing as fast as they're growing now, and they've been growing for the past 4 or 5 years, and they're going to drive stock prices in the market, that's something you have to monitor, and that's one of the things I'm a little bit worried about going in the next few quarters. But once I see that, then I'm going to start taking a lot more off the table.
And to add to your points there, Frank, Walmart just reported a record amount of sales for the quarter. They haven't had this good a quarter for sales growth in, I think, 10 years. So that tells me that at least in the short term, the Trump tax cuts are really helping the blue-collar people on Main Street, that they've gotten a bump in their wages.
They are, and it's tough to even say that, because if you mention, it's so hard with politics, right? Because it's politics like, again, whether you're Democrat, if the Republicans or Trump comes up with a good idea, it doesn't matter how great it is, the Democrats are going to bash it, and it's vice versa, right? I think that the Republicans did the same thing to Obama. So, take out Trump out of that sentence and just say tax cuts, because you say Trump tax cuts, Trump, then your feelings get involved, and then sometimes you don't invest the right way. But these tax cuts are definitely, they're helping these businesses grow. You saw AT&T, you saw other companies immediately give checks to employees right away. They're keeping jobs here. We're growing. And a great example of this is why I said the tariffs, and I told, my audience since February, tariffs is a non-story. They're going to talk about it like crazy. They're going to push it down your throat. These little, billions here, billions there. It's nothing, because when you look at the auto industry and you take the tax cuts, and I've done all the math behind this and modeled it, these guys are generating an extra $550 per car in tax cuts, and based on the tariffs, they're losing $50. It's not a big deal. But what's funny, when you look at the markets and everybody's worried that this is going to be crazy, look what's happening in China. China's market's down 22%. So I'm watching a highlight of Trump rally yesterday, and they're like, he actually said, he goes, I have senators in Congress coming to me to do a deal. I'm like, why do we need to do a deal for? So it's not a question of, even for the international people listening to this, it's not us pounding our chest in the U.S., but everybody needs us. and they have to work with us. And we're asking China just to be fair. We're not saying, well, if you don't do this, then we're asking to be fair trade. And now they're realizing that if it's not going to be fair, it's going to crush their economy. We're going to do even better. So it's interesting to see how, tariffs, how many stories, comes up on Google, it's probably about 300 million that have been warning you and going crazy. Yet it's really a non-factor, because if you really think the tariffs in China, if it's for real, there's one thing China could do that can crush us, and that's raise tariffs on rare earth metals, because they control about 85% of that market. That's used for our weapons, that's used for technology, that's used for everything. When I see that, then I know the tariff story is real. Right now, it's just back and forth and, doing little things and stuff like that. But it's something that, if you own U.S. stocks, it's a non-factor right now. And it's been since February.
And China's retaliation with the tariff seems to be trying to play games with their currency and their exchange rate, and that may backfire on them. They could have an inflation problem there inside China. They could have a lot of increasing social unrest. So there's a lot of problem. They could have capital flight, an enormous amount of capital flight. People, Chinese citizens with savings in RMB, want to take money out of the country. So it could backfire for them trying to, escalate this trade war as well.
Yeah, I'm going to take it out. Where are they going to do that? They're probably going to do it through Bitcoin and Ethereum and different ways that they could. And look at Vancouver and Vancouver prices. You're seeing the king market of mining, which has been in the biggest bear market in 4 decades, and home prices are at all-time highs. Why do you think? Because you're seeing a lot of people from China, a lot of people from India. You look at it, it's amazing how a lot of people moving out of those communities. So there is some truth to that, absolutely.
Yeah, I agree. I've heard anecdotal stories about Chinese businessmen leaving China with briefcases and buying property sight unseen here in the United States and paying way over market price, and then getting back on a plane in less than 24 hours after buying a couple of properties. So these stories have been going for 10 years now, though. It's kind of funny hearing them.
Yeah.
So I want to transition now. So I want to transition now to valuation. So you talked about the large cap companies. When I look at some of these large cap dividend stocks, Frank, some of them, they have no growth. They have no revenue growth. They've been doing financial engineering with their earnings, with the cheap debt to make earnings higher. And their PE ratios are 25 times earnings or higher. A lot of people nowadays are looking for income. So they're buying these things up. I don't, as a value investor, I really don't like those. I know you focus on small caps. So compared to the large caps, you think there's a lot more better value in the small caps then?
I think there's value in both places. I mean, you bring up a good point, because we're looking at consumer staple stocks, right? So consumer staples are usually trading at 16, 17 times. These are companies that are slow growing. They're hardly growing sales, yet why are these things trading at 22 times earnings, 25 times earnings when they used to trade at 17 times earnings? It's because of their yield. Because you can't get yield any place, right? If you find a place that you could get a risk-free yield of 3%, there's $1 trillion that you'll get into your fund immediately, right? So there's just a huge need for yield, and that's what really created the credit crisis, because we created CDOs, slapped AAA ratings on them, and trillions went into the system, and because everyone was getting an interest rate and they thought it was risk-free when it really wasn't. But you got to be careful with consumer staples and utilities. I mean, these are companies that aren't fast growers. If you want a good dividend stocks, and this is the best tip I can give you, don't buy a company because it pays a high yield. Okay, you want to look at a company and say if it's 2-3% or whatever yield it is. Sometimes you get 4 or 5 in something, and if it's a REIT or whatever, you also get that's MLPs. It's not a steady dividend; it could be paid out 90% of the earnings you need to pay out. But you want to always buy a company that's a dividend payer that's growing their earnings, because if they're not growing their earnings, especially in this market, value is completely out of favor. You have to make sure that they're growing earnings. So it sounds a little contradicting, because you're well, I want income, and you ask me for a growth stock, but that dividend is going to be secure. And when people talk about compounding over years and years and years, it's not necessarily a dividend that's making you a fortune. The people that bought McDonald's and Warren Buffett that bought American Express and all that stuff and say, look at the yields. He's not a billionaire because of the yields. He's a billionaire because of the capital gain plus the yield, which makes it to 8 to 12 to 10% returns around there over a long period of time, over decades. But you want to make sure you own a stock like Boeing that's been in, not right now. I think that cycle's towards the end, and I visited the Boeing plant in Everett, Washington. Unbelievable, guys. You should definitely do that. It's assembly line, biggest building in the world. But you want to get into companies where, okay, that's a Dow component paying a dividend, and they have a growth cycle. Caterpillar, into mining, not really. That's more of a value play. I'd be a little careful there. But you want to look at companies where, when I look at consumer staples, the Cloroxes of the world, the General Mills, the Procter & Gamble, they're not really growing. So what's the use of buying that stock to get a 3% yield if the stock's going to be down 10% at the end of the year, right? It doesn't make sense. So you want to buy companies that really have strong growth profiles, which is a lot. You'll see dividend plays out there. Energy is a great place for that. Those dividends are coming back. They were crazy leverage back in the day. I mean, 2014, 15 when oil prices came down, but right now they pushed out a lot of that debt. They restructured their operations and they're now making money. Oil prices are higher. Now they're starting to come back and pay dividends. And some of these oil producers could produce at $50 a barrel, $60 a barrel in the Permian, in Eagle Ford, and generate. Devon's a perfect example. Nice dividend there, nice yield. A company that's growing. We have to pick that up. We're probably 30% of our portfolio, but it's a dividend play that I love. And Viper Energy is another one we're both 100% on. Just had an MLP structure with a royalty. I've never seen a company structure like that in my life. I thought it was brilliant. So they just had land. They weren't drilling, but they get royalties on the land that they drill. Everybody else is drilling on that land. They pay out 90% of the profits. That thing's up 100%. We're also getting paid 6-7% on the way up. But that yield is lower now. So make sure if you're buying a dividend stock that there's not that it has to grow tremendously, but you see growth potential in it. And you'll do fine with stocks like that. Don't just go to yield, whatever. I don't know what Con Ed is trading now or what the yield is, but don't just buy stocks and say, well, it's paying a 5% yield. Because if it's not growing and it goes down 10%, at the end of the year, you're down 5%.
And this is great analysis, Frank. I have to do a stupid disclaimer because a couple weeks ago I had two suits and with badges come and visit me about my podcast threatening me. So, everything we're talking about just for information and educational purposes only, not financial advice. Do your own due diligence, talk to your financial advisor, or buy some quality research first. But yeah, Frank. Yeah, I have to do a stupid disclaimer now. The last couple weeks of my life have been ridiculous. But anyways, though, Frank, I think you make a great point there about having to grow. The company has to grow because one of the red flags is the dividend payout ratio. So if the company does not have revenue growth and normally the dividend is kind of like a marketing tool, right? To get the investors or pension funds or to buy and hold the stock. And, it doesn't normally mean that you're going to make a lot of money in the short term, but it's kind of a marketing tool with the dividend for the most part. It can compound over 10 years, 20 years, etc. But most people don't really buy and hold for that length of time anymore. But, a red flag to me is if the company, although MLPs are different, but now there's tax problems with MLPs from talking with oil people that some of them, the government may reduce the tax. They may change the tax laws from MLPs and force them into C Corps. But, if the dividend payout ratio is too high and the company's not growing earnings and revenues, like you said, not growing free cash flow, they're not going to be able to sustain or grow that dividend.
Yeah, you brought up a good point because the Vietnam company that we had, and you look at KKR, a lot of these guys with the tax cut, that was a big catalyst for these guys, especially private equity firms as well, where they, instead of even if it's an MLP structure or if it's like that private equity structure, or where they're paying out a partnership structure at LLP, with the tax cuts, it makes more sense to them to transition over. Now, why would they do that and why it's a benefit? One is now that they're saving that much in taxes, because the reason why they structure MLPs and LLPs and stuff like that is to avoid the taxes and pay out most of their earnings. But now with the tax cuts, now they're going to generate more earnings. And when they make that switch to be just a regular corporation, there's a lot of funds. Now you open up the door to trillions of dollars to come in because there's a lot of mutual funds because of their tax structure and KY's got to fill out and all that nonsense I won't bore you with. But now that they change their structure, that's used as a catalyst for more money to pour into these things, and they're paying higher dividends. So you saw, that's what happened to Vietnam. It took off. You see KKR is taking off now, So when they change that structure because of the tax cuts, it's actually benefiting shareholders right now. So those stocks are going a lot higher.
And the hedge funds and private equity guys, they have huge lobbying dollars to keep that carried interest. So it's a big fight over that. It's a debating issue. It's very complicated for people who are not who are beginners listening to this podcast. You probably don't want to bore you with the details. So Frank, I want to ask you about your methodology for picking out small cap stocks. Do you look top down then bottom up? Do you look at the macro picture a lot, or are you mostly a bottom up type of investor first? You're looking for a quality company that's maybe undervalued, that has good fundamentals and good growth prospects, and you don't care as much about the macro picture.
I've been doing this for 25 years, and I would love nothing more than tell your audience that there's a 3-step process that I use, and if you do, it's going to work out every time. But what I realize from making tons of mistakes is it's all the above. From a marketing standpoint, that's terrible because people want to market. If you could tell them do A, B, and C, this is what happens when you see this. But the truth is, if there's one style that worked, everybody would use it, right? And usually it gets it. Everybody will pour into it, and usually the results happen just like the credit crisis when everybody goes to one side. But you have to be open to everything, and that's why if you're looking top down, yes, I will look at markets where I'm very familiar with the oil industry. I've visited every major shale oil. I have great contacts in it. And I would like oil companies, and I say, okay, Permian's the lowest cost producer. That's where you produce it for 30, 35 in some of these areas, and 4 special counties, not all the Permian. I look for stocks that operate in there and find the best ones that are not as leveraged, right? That could be a strategy, which has worked. I look at biotechs. When I look at biotechs, it's not that I feel like biotechs is that's the industry to be in right now, where I'll look at individual companies where the best time to buy them is when 2 things. One is when they miss an FDA approval, right? If they're not even FDA, if they're in phase 1, phase 2, and their data isn't as good, you're going to see these things get crushed 50%. Sometimes that data is so bad where they'll take the platform and say, okay, we throw it in the garbage, then ignore it. But a lot of times they'll say, well, the FDA will say, you know what, we just want to see a little bit more of this data. And, and they'll submit the data, put more studies, more people in their studies, and they'll report it 6 months later. In the meantime, the stock is down 60, 70%. These things get destroyed. And sometimes they'll fall below the cash they have in the balance sheet, and you're getting the rest of their pipeline for free. So also the best time to buy biotech stocks a lot of time is right after they get FDA approval. Because what happens, and this is weird because this goes against anything you've ever read in an investment book, but when you get FDA approval, it means now you're going to start generating earnings and sales. But what happens before that process is you're spending a ton of money, but there's doctors and scientists running these companies. And then when you get FDA approval, these doctors and scientists know nothing about operations. You got to buy factories. You got to talk to insurance companies to see if you're going to get reimbursed for this stuff. You got to produce the drug, distribute the drug, hire hundreds of employees, sales employees, marketing agents. They don't know anything about this. So usually when you get the FDA approval, you're going to see the sell-side analysts put on these inflated estimates. This drug's going to sell hundreds of millions of dollars. And they fall flat on their faces the first 2 years because they're running around with chickens. They had cut off, And it's funny because you'll see these stocks get hits like Human Genome went from 32 to 8 and got bought out like $12 from Glaxo. I mean, you see this a lot when companies actually have a drug and you're about to generate sales, but it takes a while. Even if you look at the best drugs like Merck and all these guys who have operations in place, you look at Avastin, you look at Rituxan, you look at Keytruda, which is an immunotherapy drug from Merck. I mean, you look at the first year sales are horrible, and now it's like even Humira, which is the number 1 drug in the world for your immune system. I mean, that's generated like $100 million in sales this first year. Now it's like $18 billion in sales they're doing. So it takes a while, and how this is in this market where people just run immediately on the first sign of bad news. That's what we do. We'll jump in and analyze and say, wow, this thing shouldn't be trading at this value. So there's different strategies that I use.
It's also these high-frequency trading computers that anytime there's bad news, it just seems that there's more volatility, that the slam of the stock just happens faster and it's larger than normal. So a lot of these, news-driven things, it moves the stock up faster and higher, and then if it's bad news, it moves the stock down faster and lower, even faster than in the past.
Yeah, no, it's true, and you have to use that to your advantage, right? Because what is these algorithms? It's basically front running, right? They're not buying stocks on fundamentals. They basically have mathematical models that see all the orders in there, and they know when they get triggered what's going to come down, how many shares are going to get triggered, and they basically front run that. And it pushes these stocks where you'll see it in every earnings season. If they report bad earnings, the stock will open up down 10%, it'll finish down 25%. If they're up 3, 4, 5%, they'll be up a lot more. And, you look at the shorts, and it doesn't really have a big short position, so it's not short covering. But use that to your advantage, because when you see stocks that, maybe insiders are buying, and then they come out with one bad quarter, and, you see it down 5%, at the end of the day, it's down 15, 20%, use it to your advantage. It's a good buying point. A lot of that is just forced selling, everybody getting out of it. You could buy the stock. You see insiders buying at a much higher price. I mean, these are things that we monitor. It's different strategies and stuff like that. There's a lot that goes into it. I really wish it was easier than that, but it's not. I've been doing this for such a long time.
Yeah, I agree. Insider buying is an important measure for long-term success of a company. But do you have someone with like a science background look at these biotechs, or do you think that's not really required then?
It's not required. You just have to do the work. I mean, I don't sound like a scientist. I know a lot about immunotherapy, gene therapy. I know these because I read, I research, I'm interested in it. It's remarkable Immunotherapy is the first time in over 100 years that, and you look at every other disease outside of cancer, and we've made tremendous progress. It's 100 years before finally immunotherapy came on the scene, probably about 2010, 2011. And for me, being in this industry so long and having a podcast with Wall Street Unplugged, where I do what you do, right? We interview really cool people all the time. That I'm biotech analyst and working on Wall Street. What I do find something that I like, I also have great people and great contacts, just like you have an amazing network of people that you've been interviewing, where I'll say, hey, guys, what about this? What about this trend? And I'll be like, it is amazing. This is great. And it's being forced me to look even more. So you don't have to be a scientist, but, the worst thing that happens is you research the company, you learn everything about immunotherapy, which is basically your immune system. When you get cancer, your immune system fights it and then gives up, and then the cancer spreads. So now they find drugs to tell you the immune system to keep fighting. And what it does is it's the most powerful thing in the world, your immune system. Basically, it's crushing cancer. And you're seeing that, actual kids that were being told that, hey, you got a year to live. They're 5 years later. It's the first time it's happened in a long time, and the technology's going into this is incredible. So it's interesting to me, and maybe it doesn't result in the stock pick. It did, and we had a lot of winners in it. But, you learn so much. And every time you're researching something different, the oil industry, I didn't know 15 years ago, I didn't know anything about the oil industry. I didn't know about biotech. I go to Consumer Electronics Show every single year. I learn about every single technology trend that I follow. So if you put the effort in, remember, this is your money you're investing. You should learn as much as you can, and there's no reason at all, unless you're lazy, because you got Google, and you can Google anything or find anything and call anybody. Just call anyone. People love talking about themselves. You could get so much information out of people, and you build your network, and it takes a long time, but, it's pretty cool as you start building it. You start getting good contacts, and it results in you having great information, and, believe me, it'll definitely show up in your performance.
Yeah, I completely agree. It takes a long time to build a good contacts list. So from what you've described with the FDA approving a drug and then the process, how it could take years to get the insurance, the health insurance approval for the drug, and the manufacturing and the selling, and start to make a profit off of it, it sounds kind of familiar, similar to what a junior miner goes through after they've had some successful drill holes. They've done, the studies to bring it from preliminary economic assessment to pre-feasibility to feasibility to a mine. Because, while the mine, they think they have a mine, they're raising the capital to build the mine, normally after that discovery, the stock price crashes. Because then investors say, oh no, now they have to raise hundreds of millions of dollars, and so the stock crashes. But once the mine is built, there's the opportunity then for a lot of the capex drops, and there's the opportunity for profits after that. Would you say that the biotech, once a drug is approved, is similar to that?
Not necessarily, because I'm talking about just the first year. You're going to see sales come in, but it's really the first year, and it's not the insurance companies aren't going to cover them. It's just a reimbursement, right? So what happens is these companies have to report every single quarter. And a lot of times, the company called Vitae that we recommended, that we're up really good on. Again, I've had losers, guys, and I'm not just, going to shout them. A lot of my winners, I have more winners than losers, or I wouldn't be, I have a different job. But they had trouble, getting reimbursements, which means they're going to miss the quarters really bad, and the stock's going to get hammered. But this was just them figuring out, with this insurance companies, when are we going to get this, and how to figure out when is it definitely going to get covered. And they don't know these systems yet, right? These are just doctors and scientists. So with mining, I'll blow your mind away here, and you probably know this from interviewing Rick Rule. 1 out of every 3, basically projects go from early stage to becoming a mine. 1 out of every 3,000. So next time, if you go to PDAC, which they have in Toronto every year, you see 4,000 companies there. And a lot of those guys have multiple projects, but just know what the odds are of those guys actually coming to market. With the FDA, it's a little bit better, where I think it's a 10,000. I think it's it's like a 5,001 shot or whatever, but it's for drugs. But you see a lot of drugs. You could see early in phase 1. You can really look at that data and understand how this is going to be a big deal, right? It's a lot easier when it comes to biotech. In mining is just the worst business on the planet. The margins are horrible. There's not even any new technology there. It's not like drilling in oil and shale. You're blowing up mountains, and it's just a mass. And you're looking at biotechs are not really contingent on a commodity price, right? If you come out with a drug for a rare disease, you could, it's going to be fast tracked. You could charge as much as you want for it. You could find a great discovery. Say when not oil prices, but gold was, 1900 in 2011, 2012. and you just found a major high-grade gold discovery and found out that, based on your PEA study that, you're going to be profitable at 1,300, and you're high-fiving yourself. Well, gold is under 1,200, maybe 1,200, I don't know today, and you're done. You can't even develop the project, right? You're not going to raise money for it. So it's a lot different from biotech, where once you're getting that positive results, it's a good shot. That's going to come to market, regardless of what's going on in the economy, where you're really contingent on that gold price, which has come down. You saw uranium as well is just totally out of favor. Right? So we're at 130 Fukushima, pre-Fukushima, 2010, 11. Now, what are they, 26 today? People are high-fiving 26. They were below 26. So it's a little different, and, the mining industry is extremely dangerous, guys. I know I have great contacts. I speak at these conferences all the time. 9 out of 10 times you're going to lose money in that industry. But when it's all about the cycle. If the cycle turns, and it's been one of the worst cycles ever outside of a 9-month period between, the end of 2015 to mid-2016, but since 2012, it's been one of the worst markets in 40 years. And when the cycle turns, just pick any stock, and you're going to make, when you make 200, 300, 400%, especially on junior miners. It's amazing. But, you don't necessarily do that in biotech. It really contingent on what's working, what's not working. So there is a little bit of differences, but it's also similarities too, because there's certain stages, right, that, to develop. And as you report positive news, your stock's going to go higher and higher and higher. So there's similarities and there's also differences. So hopefully that answers you. In a long-winded way, answers your question.
Yeah, we're recording this on Thursday, August 23rd, 2018. The gold price is actually below 1,200. It's at 1184. I just looked it up while you were talking. So it is, the miners, a lot, even the lower cost supposedly producing senior gold miners are not making much of margins right now. No, they're not.
So if you're, and if you look at the gold producers, the major ones, it's tough for them. They're almost like juniors now anyway. They've come down so much, but they need gold. Just like oil, what do you need? You need to replenish your oil, right? There's only a certain amount in every hole. So you basically, with gold, these guys are in dire need of gold right now. So you have junior miners just, staking their claim, finding these little things, and their 100% their goal is not to develop that, but to sell that project to a major, right? Because they need gold, right? They got to replace it, and they're running out. There hasn't been any major discoveries over the past 3-4 years. The guys cut back significantly on spending. That's a catalyst, but you're going to need gold prices to go higher, and but it's worth having exposure to and having a few junior miners, because if you have $1,000 to throw into these things, you'll see 300, 400% returns in 6-7 months. But just understand that there's a good shot that 1,000 could turn into $200. If you go with that mentality, then it's worth it. But a lot of people go in there and they're down 20% in 2 weeks, and they're like, "Wow, what's going on? This is crazy." You got to expect that in that industry. It's pretty crazy right now.
And I think there's major headwinds for the gold price. You've had this dollar rally, but there's also problems in emerging markets. So as long as there's that global macro overhang, I just saw an interview from Raoul Pal on Real Vision TV, one of the former top hedge fund managers, and he founded Real Vision TV. He did a long video for their website in the last couple days, and he thinks that commodity prices across the board are going to fall more than 20% in the near future, and the dollar rally is going to continue. So if he's right about that, the mining industry for gold and silver, Frank, has been in a bear market for basically 7 years now. So they've cut costs to the bone. I don't know. Some of the higher cost ones are going to be in trouble.
Well, let me ask you this: because dollar's going higher right now, but when the dollar went lower, where did gold go?
Gold did have a rally, right? Gold did have a rally. It got above 1350.
Not really. You're looking at where. We've been between a range of 1100 to maybe 1275, pretty much for a while now, but. We've had a period, and it's just, you're going to have gold bugs say what they say, and it's important that you make sure people just don't have an agenda, or they don't have a bias, whether they're a perma bull or a perma bear, because they're going to feel a certain way no matter what conditions are. Again, I'm a data-driven guy. We've seen high interest rates. We've seen low interest rates. We see interest rates going higher, right? What's happening to gold? Gold didn't move. We've seen inflation coming to the market right now, which should be amazing. We were told, right? You could go study that. Could also show you studies that deflationary periods are good for gold. But most of the time, you say inflation is great, and we're seeing inflation. Gold should go higher, and it's not. It's supposed to be a safe haven, but it's not. The dollar is a safe haven. When we see all these things go wrong, people jump into the dollar. During a credit crisis, nobody was buying gold. Gold got killed as well. So we're seeing all these conditions that are supposed to be Trump getting elected. That's supposed to be the biggest driver of gold, total uncertainty. What happened? Gold crashed since he got elected. So It's kind of fun, and I'm not knocking on anybody. For me, I'm trying to see what is going to move gold prices higher. Maybe it's just fundamentals. Maybe just it's these gold miners, these majors have to replace their reserves. There's no major discoveries, and just a supply demand issue. But other than that, I don't know if higher interest rates. I don't know if the dollar going higher is bad. I mean, we saw the dollar low, and think about the last 5 years, 6 years that gold has been in a terrible, horrible bear market. We've seen high interest rates, low interest rates, dollar go high, dollar go lower, and we're still kind of like at the levels where it's super depressed. And we're seeing junior miners down 80-90% from their highs. So it's kind of interesting to see, we hear these things are going to drive gold higher. I don't know if the dollar is going to drive it higher. I know that inflation should drive it higher, I would think, from these depressed prices, but we're still not seeing it. So, yeah, it's an industry that's pretty crazy. I've been, and the reason why I'm telling you this is because I've made mistakes. I thought it was going to turn 2 years ago and a year ago, and I stopped out of a couple of stocks. So I'm very cautious. I would tell you, if you're going to invest in this industry, wait for the trend to turn. I missed the first 30% move. Who cares? I mean, they're down 80%. You still make a fortune, but I would wait for the trend to turn and get some excitement to the industry, because right now, even companies that report good news and they report good drilling results, they'll go up 3-4% of the day. They'll finish down 10%. Why? Because it's used as a liquidity event. You get all these buyers coming in, which tons of volume in your stock, and people are just dying to get out of this industry. They're using it to dump their shares. They don't even care. That's a bear market. So, it is dangerous right here, but I'm not so convinced that a weaker dollar is good for gold prices as much as, a higher dollar is bad for gold prices.
And there's also not a lot of capital available for the producing miners and also for the juniors. So there has been, I think, over the last 7 or 8 years, over $80 billion in bad deals that the miners have written off, according to hedge fund manager John Paulson. So a lot of people don't necessarily trust the miners as much as maybe some of them have changed management teams, but I think, because there's been mistakes in the past with bad deals and bad acquisitions when the prices were higher, that people are a lot more skeptical to give the miners money. But I'll tell you who's in the driver's seat. So if this bear market continues, like you said, for whatever reason, the 5 largest royalty, so this is not going to move the share prices up necessarily for these companies, but operationally these companies are setting themselves up for the long term a lot better, because they're the only ones left with good balance sheets and capital are the largest royalty and streaming companies. So the Franco-Nevadas, the Wheaton Precious Metals, the Royal Golds, the Osisko Gold Royalties, and the Sandstorms, those guys are the only ones with money now. They're doing deals like crazy. Their phone's ringing off the hook there.
Yeah, no, they did. But remember, those deals are contingent, and those have outperformed everybody else. But those deals are contingent. What they're doing is they're basically finance companies, right? That's all they are. They have 10 employees. They're like, okay, we like this project. Once it starts producing gold, we're going to get a piece of that. And sometimes they're so good right now, especially, the guys like Noah Watson, Sandstorm, and all the guys, Pierre Lassonde and stuff. But they're able to make deals, even if gold prices come down. That's all contingent on a lot of these companies producing gold. So if we don't see that, we could see the royalty companies get hit as well, right? Because they're spending a lot of money on this. So they've done fantastic right now. And the large caps have done pretty well, but just the junior miners have really come down. But we need to see higher gold prices, or we're probably going to see those royalty companies get hit pretty soon too.
That's interesting. That would be a total bust then. That would, a lot of supply would come offline then in a short amount of time, because from what I've heard, there's really if the royalty and streaming companies, they're really the only people providing capital for the producing miners and the juniors right now. If they can't give the producing miners capital, the supply is going to come offline probably faster than even what's happened in uranium. Yeah,
and where do they get the capital from? If you think about it, right? They get capital by generating more and more money from these royalty streams, and right now with a lot of these producers not really producing as much, and gold prices coming down, the economics not working, that's going to lower the amount of money they can put in some of these things. But they know how to leverage themselves and things like that, but it's not a sure bet that these royalty companies are great, because I've known personally a lot of CEOs of this industry, the Keith Neumeyers, Amir Don, these guys who I respect the most, who started companies thinking there was a bottom of the cycle 3 years ago, and their stocks are down 60% plus. So, and it's nothing against them. They're great. They just, guys that have been in the market for 20 years that understand these markets, that believe hey, we're going to start these companies and buy up these cheap gold assets. Well, what happens if gold stays low for another 4 or 5 years, which no one's anticipating? Now, why own that stock? So it's a crazy industry right now, but when it does turn from these depressed levels, it's one of the few industries that could offer you 400%, 500%, 600% gains, and those gains happen very, very quickly when the cycle turns. It's just I may not be the guy to ask because I have no idea because I've seen every single condition. I've listened to every bear. I know Doug Casey, the Maricatuses of the world, great guys. The Rick Rules and stuff like that, Eric Sprotts. And, I've been told by guys who've been following this for 30, 40 years of what's supposed to drive gold, and none of that stuff has worked at least the last 4 years. So it's when it turns, I'd probably wait for the trend to turn. That's the safest bet.
So you think the commodities bear market could still be ongoing then for a while? That's very interesting. I mean, there's just so many commodities markets that have been, like uranium, you would have thought, like Rick Roll, I've listened to him lay out the case for uranium, and that even with the supply cuts from the largest uranium producers, the market still hasn't turned yet. So a lot of these commodity markets, things are not really acting as you would think that they should be.
Yes, and that's what scares me, where I still think that, and I think, from what I contact on my senior, there's still people dying to get out, there's still funds trying to get out, there's still forced liquidation taking place, and there's a lot of cutthroat stuff going out there, and it's just, it doesn't feel like a bottom yet. I think we're pretty close, but I could see still more pain ahead. And for me, again, wait for the trend to turn. Wait for the trend to turn. You see more optimism. You'll see, more money being raised and things like that. But until you see that trend turn, then I think you stay out of this market for now.
Okay, that's fair enough. I mean, a lot of my listeners are very, very bullish gold and silver, but they've been buying on the way down. Some of them just buy our gold bugs and they don't care what the price is. They just don't trust the government, any government, and they just want the metal, and they just want to be out of the markets entirely. They don't trust any of the rise in stocks or anything like that.
Yeah, I'll end with this, Jake. Look, I've been doing this for 25 years because we all have our own beliefs. We all have our religious beliefs. We all have our political beliefs and everything. But to be a great investor, you need to be challenged. You need to see things that are working that don't make sense, and don't just dismiss it. Say, why is debt going so high? Debt's through the roof. Why is the stock market going higher? Figure it out. Like, try to figure out why things aren't working. Not that I have this bullish approach and I hope the government spends more money and you're saying, who's this idiot Curzio you got on? It's just from my experiences, instead of just like saying this, having that mindset like this is supposed to happen and it's not, instead of just keep running into that wall, try to just look around and say, okay, why isn't this working? And that's helped me over my career. And I'm not, giving you this advice like I'm some kind of genius. I'm giving it to you because I've made tons of mistakes, and I made mistakes investing in mining companies over the past couple of years, and now I'm completely out of mining and doing great in the stock market. So, for me, diversifying, going to areas that work have really helped me, and just, be open to that. Don't be so focused where I like gold, I hate the government, that's all I'm going to own, because if you had that focus, you watch the market go up 300% while gold's down, your gold stocks are down 60%. And again, it's all about making returns and, making health better for health, you retire, families and stuff like that. So, that's worked for me over my career.
Do you have stops or stop loss limits or those things set in place for your positions?
Yes, every one of my positions in my portfolio is on Curzio Research. We have the Curzio Research Advisory, which is a cheaper portfolio. Where I say cheaper, it's one that I've made that's affordable. It's like $49 for the year. That's for large cap and mid caps. And then my other one is Curzio Venture Opportunities, which is more of a $1,500 to $3,000 price tag. That focuses. We also have private placements in there because I have a lot of great contacts. I get paid for anything. So for me, I don't get paid by researchers. I don't get paid by anything. I have to show you gains or you cancel. That's it. So you can see an archive of everything I've ever done. You can go back to my podcast, Wall Street Unplugged, for 10 years and look at everything that I've said. So everything's there, and there's accountability there, which I think no matter who you're following, it's a newsletter, just make sure, you're doing your research on them. Make sure that, look at their performance, their track record, and don't just buy because of a hot promo and stuff, because, I've seen a lot of people get hurt that way. So, and yes, I do use stops all the time. You got to limit your losses. It's not a perfect system. I've seen stocks hit my stop and then go up, but there's certain times when, remember, if you're wrong and your stock goes down, think about if you don't have stops in the mining sector. I mean, instead, and just forget about the money, but think how it is psychology, right? So you just stopped out of your stock. Now you have cash on the sidelines, right? All right, fine. You took a 25% loss, 35% loss. Now your stock that went from 10 to 750 you're out of, and it's $3 now. I mean, the bear markets are a great thing for people who are prepared. And if you're going to follow that bear market down without stops, you crush, you lose all your money, you can't invest it anymore. So you want to protect your capital, remain liquid, and you do that, and you take all the feelings out by if it hits your stop. If you take that 25, 35% stop, just to make sure that your gains, you believe that stock can go up more than 100% from a risk-reward profile. So, we always use stops to protect our capital, and you want to limit your losses and let your winners run. I mean, that's how, the best investors really do it.
Yeah, and I think risk management is very important for investing or trading short-term or long-term for a diversified portfolio. But with these high-frequency trading computers now, basically if you put a stop inside your with your E-Trade account or whatever brokerage you use, they have access to that. So they blow out stops. So, if you entered that stop limit order or stop loss limit order into the order book, they saw that. So they blew out your stop intentionally now, and then they move it right back up. So people have to figure out ways around this now. Unfortunately, this is the new normal. I don't really like the trading systems that have been set up, but, I don't have much of a say in things. But, Frank, I think you brought up a great point there with resource stocks. I mean, there's so many people now in the gold community still, very, very smart people. I'm friends with them, too. You mentioned some of their names. And they've been saying for all the way down for years now how gold and silver are still in a stealth bull market. But, look at the tape, look at the miners, look at the prices of gold and silver, and saying that things are in a stealth bull market when you can't raise capital, when companies can't raise capital, it's not a stealth bull market.
All I gotta say, if gold is a bull market right now, then what are stocks in? I don't know. I think the logic behind that I just don't get. But and I'm not making fun or picking anything again. We've all been wrong on things, but to say that that's in the bear market being down that much over a long period of time and looking at it, it's just using excuses to basically miss the fact that an industry is getting destroyed right now. So you just play smart. Your money. You don't have to listen. Or do your own homework, do your own research. But even if you believe in gold, doesn't mean you have to stay in it the whole entire life. There's certain periods that it buys and certain periods that it sells, just like what's, in certain stocks as well.
Agreed. And I'm a contrarian. I've read a lot of investing methodology, studied a lot of the great investors. Sir John Templeton is one of my favorite ones. And, bull markets are built on pessimism, rise on skepticism. We're just not seeing that in a lot of the gold market. If things were rising, if gold prices were rising and miners were able to raise a little bit of capital and they were still skeptical, that would be signs of a stealth bull market. But we're not seeing those things where prices are rising and miners and juniors are skeptical about it. We're not seeing evidence of those things yet. So that would be what I would define as a stealth bull market. We're not seeing that stuff yet.
No, definitely agreed, bud.
Well, I want to thank you for your time today, Frank. I think you gave a lot of great insights. Obviously, this is not financial advice for the suits and badges listening to the podcast or any gamblers there. This is not financial advice, just for information and educational purposes only. And I appreciate you staying on for almost an hour, Frank. And if our listeners want to listen to your podcast and take a look at your newsletters, how do they do so?
Thanks. They can do that. Wall Street Unplugged. It's for free out there for everybody. So my Wall Street Unplugged podcast. That's on every Wednesday where I interview somebody, an expert, and a lot of guys that I mentioned on today's podcast. I interview these guys and really quality interviews and stuff. And then Frankly Speaking is another podcast where I just take questions from my audience at frank@curzioresearch.com, and I'll just randomly take 3 or 4 and some of the Frankly Speaking podcasts. And you can go to Curzio Research to find any of our newsletters from any of our advisors and stuff like that. But I appreciate that.
Great. Well, we'll have to have you back on again in the future. And, we live in very interesting times, my friend. Things are always constantly changing now, and we have permanent reality TV with all the current events happening with both political parties. Yeah, and just, it's hard to just be careful of the news flow and what you hear with tariffs in Italy and all this stuff. I mean, their job is to inflate these stories to get more page views, to put on guys that are going to call 50%, 90% crashes, or the market's going to go up 500% because they're getting more page views. It's not about quality. It's about entertainment. But use that to your advantage, because a lot of people are going to trade according to that and get scared and do things. And you're going to get in at good prices in a lot of stocks. And if you're smart, you stay ahead of the news. Yes, and even President Trump is involved in this. He's saying that if he's impeached, that the stock market would crash. I'm not so sure about that, but, he's trying to inflate his value there. Yeah, no, it's pretty funny. Okay, great. Well, thanks again for your time, Frank. I appreciate it. Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website, and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.